Hello, welcome to the Hammer Museum. I'm Claudia Bester. I'm the Director of Public Programs here, and I'm pleased to introduce tonight's Hammer Forum on Community-Based Banking with guest speakers Dennis Kelleher and Wallace Turbeville, and moderated by Ian Masters. Tonight's forum will look into why the United States, unlike other developed nations, has no public infrastructure banks and so few state and community banks. And now I'd like to introduce our moderator, Ian Masters, who will introduce our guest speakers. Ian is a BBC-trained broadcast journalist who's covered national security affairs for over 25 years on public radio. He's the host of Daily Briefing every Monday through Thursday at 5, as well as Background Briefing on Sundays at 11 a.m., all on KPFK 90.7 FM. Ian has been a senior fellow at UCLA's Center for Strategic and International Affairs and the UCLA Center for International Relations, and was a consultant to the Center for National Security Studies at Los Alamos Laboratory in New Mexico. Please join me in welcoming Ian Masters.
Thank you, Claudia, and all of you for coming tonight on this May Day, a day which workers of the world celebrate everywhere except here in the United States, where we call it Job Creators Day. Nevertheless, it may be appropriate that we are discussing the engine of American capitalism, Wall Street, on this day to determine whether the big banks are driving us off a cliff, as they almost did in 2008. Back then, they were just too big to fail. Now they are too bigger to fail. But the next time the bubble bursts, we won't have the 12 trillion to bail them out. So a day after the stock exchange reached a record level, we'll explore whether there are other ways to stimulate and nurture entrepreneurism, innovation, and incubation for startups and small businesses, as well as enable states and municipalities to invest in infrastructure for roads, parks, water treatment, etc., and allow citizens to obtain affordable financing to buy homes and cars, and for students to get an education without being indentured for life. At this point, for all of the above, we have one-stop shopping and have to turn to the big five banks at that uneasy intersection between Wall Street and Main Street, where the rubes meet the slickers, the minnows meet the sharks, arithmetic meets arcane algorithms, the family farmer the flash boys, and the household the hedge fund. Now, before I lead you in a rousing chorus of the Internationale, it's worth pointing out that banking reform is not an issue exclusive to the American left. The conservative scholar at the University of Chicago, the Hoover Institution, and the Cato Institute, John Cochrane, recently offered the most radically anti-bank schemes of all time, basically a call to ban banking. This prompted the liberal columnist and economist Paul Krugman to write, "Cochrane's proposal calls for a remarkable amount of government intervention in finance. It makes liberal proposals for a transactions tax look like minor nuisances." As a frame of reference for tonight's discussion, if we compare banking in the bastion of free enterprise and market competition, the USA, to our economic competitors, questions do arise. In terms of public infrastructure banks, we alone amongst the advanced nations do not have them. If we did, the city of Birmingham, Alabama would not be bankrupt because local politicians got snowed by Wall Street bankers into paying for the world's most expensive sewage plant. The biggest bank in Japan is the post office. And we used to have post office banking in every corner of America up until the late 1960s, when the banking lobby quietly put them out of business. Meanwhile, starting in 2007, our United States Postal Service has been deliberately bankrupted. Conservative free marketeers in Congress have saddled the post office with a uniquely onerous requirement to prepay 75 years of pensions. And while the USPS is desperate to find new revenue streams like offering banking services in rural America, which the Congress won't allow them to do, in the name of competition, Congress is allowing post office kiosks to open up in Walmarts. And in terms of community and state banks, they are more the rule than the exception in most countries, but in the US, we only have the Bank of North Dakota, created in 1919 when populist movements swept the plains. The Bank of North Dakota is the only state-owned bank in America, a bastion of socialism in a red state. Last year, it earned a record profit while its competition in the private sector lost billions. This could have something to do with conservative rural values investing heavily in agricultural staples and not getting into housing speculation, but more and more scholars, politicians, economists, and businessmen are heading to Bismarck, North Dakota to find out what's the secret sauce in the state's bank vaults. So, could state-owned banks across America have gotten us out of the 2008 financial crisis we are still saddled with? And could opening up state banks across the country avert the next one? A question for our guest tonight, perhaps from Ellen Brown, author of the book Web of Debt, who I understand is in the audience. In it, she wrote that the Bank of North Dakota, with its $4 billion under management, has avoided the credit freeze by creating its own credit while leading the nation in establishing state economic sovereignty. First, we will hear from Dennis Kelleher, who is a watchdog of Wall Street and a thorn in their side. Then we'll hear from Wallace Turbeville, formerly with Goldman Sachs, otherwise known as Government Sachs, who has been dealing with the Detroit bankruptcy, which in part seems to be a result of the predatory relationship between Wall Street and Main Street. Then we'll have a discussion, then extensive Q&A. Dennis Kelleher is the president and chief executive officer of Better Markets, Inc., a Washington, D.C.-based nonprofit organization that promotes the public interest in the U.S. and global financial markets. Better Markets is a Wall Street watchdog that is being referred to as a persistent thorn in the side of Wall Street, and Dennis has held several senior staff positions in the United States Senate, most recently as the chief counsel and the senior leadership advisor to the chairman of the Senate Democratic Policy Committee. Ladies and gentlemen, Dennis Kelleher.
Thank you, Ian, and thank you, everybody, for being here. I should warn you that although I'm based in Washington, D.C. with Better Markets, I'm from Massachusetts, so I tend to talk relatively quickly, but then again, our alphabet doesn't have all the same letters you do, so it doesn't take quite as long. I thought I'd take a step back to start and lay the table here from Wall Street to Main Street. And it's the case for community banks. If we were just going to talk about infrastructure banks, it would take about 3 minutes, and Ian covered most of it because it's North Dakota. So I thought I'd first go back in history to talk about kind of where we were and get us up to where we are now. So finance before the 1930s Great Depression, there was little, if any, banking, a regulation of banking, finance, or the capital markets in the United States. There were frequent crashes, actually about every 10 years or so. They called them a panic because actually they named it after the reaction of people, right? They all panicked. But after the panics, what happened was they were followed by economic downturns of varying severities, including very significant, what you look at as mini depressions, but not actual national depressions because of the kind of fragmented economy at the time. And then, of course, we have the great crash of 1929 and the devastation of the Great Depression. It's not just the crash, but, of course, all the familiar scenes that were seared into the memories of those generations. And the response, which people don't talk much about or think about much nowadays, is the United States created actually multiple layers of protection of several different types between Wall Street and Main Street. The sole purpose was not only to have financial markets that worked, but to actually protect Main Street from Wall Street. And those types, there were structural protections, there were regulatory protections, and there were supervisory protections. And most importantly, there were multiple layers of each. And so what was the result? Let's think about this. There was no systemic crash in the United States from 1929 to 2008. Banking and finance was highly stable. Banking was diversified. There were a few big banks, but there were thousands and thousands of small banks throughout the United States. Banking actually supported the real economy, and it was a relatively small, balanced part of the economy. And what's really interesting is the economy grew tremendously, and there was widely shared prosperity. And most importantly, one of the things that I talk about a lot that people don't think about is the United States actually created the largest middle class in the history of the world during this period. And when did they do it? They did it at a time that Wall Street prospered, and remarkably, they prospered under the heaviest financial regulation ever, which, of course, we know if there's regulation, it kills finance, business, and all things on God's green earth, right? But in fact, history proves that the sky is falling. Chicken Little arguments of Wall Street and everybody else about regulation is actually objectively false. And so that worked pretty well until 2008. And now everybody remembers Lehman Brothers on September 15th? Stock market crashes, Bailouts, Ian referred to $12 billion, or $12 trillion in bailouts. It's actually on the low end. It's probably the ultimate cost of the crisis, which I'll get to shortly. Probably on the low end, about $15 trillion, high end up around $40 trillion. We know the familiar AIG, Citi, Goldman Sachs, Morgan Stanley, J.P. Morgan. Interestingly, every one of those banks would be bankrupt. The shareholders would have ended up with zero, but for U.S. tax dollars and government policy. So why did that happen in 2008? It mainly happened because of deregulation, which enabled massive growth, both in size, business lines, complexity, interconnectedness, and importantly, leverage. And it resulted in a handful of what I call too dangerous to fail banks, what's often referred to as too big to fail. But it's actually not just size. It's not just bigness. It's a variety of other things, complexity, interconnectedness. That's why I call them too dangerous to fail banks. And actually, banks are a misnomer. They're actually trading houses, enriching themselves at the expense of everybody else. And those few giants became a danger to not only the financial and economic system of the United States, but the American standard of living. How? Starting around 1980, there's a financial industry and free market ideological fundamentalists pushed to unleash and unshackle finance. Mostly the very few richest, biggest banks on Wall Street selling the siren song that bigger is better. We must compete in a global world. We're all global now. So Wall Street, very importantly, and people need to understand, is that it used its economic power to buy political power to get yet more and more concentrated economic power. Now, unfortunately, it doesn't end there. They've used it to actually purchase more political power. But by 2000, virtually all regulation and law enforcement of the financial markets in the United States ceased. Gigantic global banks quickly emerged starting in 1999. As I said, not only bigger, but more complex interconnected leverage. And this part of the banking and finance sector, Wall Street, became all out of balance relative to the real economy that finance, after all, is supposed to support. The result was a crowding out of both the real economy and the rest of the non-gigantic banking industry. So here's an interesting chart. On the left-hand side, in 1995, the size by asset of the 6 biggest banks in the United States relative to GDP was less than 20%. It was about 17% if you take all their assets of GDP. By 2008, when the crash happened, their assets equaled about 63% of the gross domestic product of our entire country. I mean, that's just the 6 biggest banks. It's astonishing. And that's not all. Real corporate profits, you take financial versus the non-financial sector, from 1929, far left here, all the way over to the 2010 fourth quarter. And these numbers on this chart, actually these 3 charts are all thanks to Simon Johnson, who's a professor at MIT, wrote a terrific book called 13 Bankers, wrote a subsequent book called White House Burning, which you all should read. But so I'm using his numbers. But you can see that the financial sector tracked the real economy, the non-financial sector, quite well until we get into about the 1980s. And then it skyrockets once complete deregulation happens about 2000. Now, this is one of my favorite charts, and I apologize for too many charts, but this shows financial sector profits as a share of total corporate profits. So you can see at about the peak, they were around 43%. The financial sector, 43% of total corporate profits in the United States. Now, the financial sector is supposed to support the real economy. It's supposed to actually provide the circulatory system, financially speaking, to help it grow, make products, and elevate the standard of living. And in fact, it became cannibalistic on the real economy. When 44% of corporate profits are actually the financial sector, you don't have much left for the actual real economy. So the result in just a few years is you have the worst crash since 1929. You have the worst economy since the Great Depression. And I was a senior staffer in the United States Senate during this time, and I can tell you the most senior policymakers in late 08 and early 09, and I was in the briefings with Ben Bernanke, the Treasury Secretary, the head of the National Economic Council, and others, we just barely avoided a second Great Depression. And at the time, in the first quarter of 09, and I think Chairman Bernanke has said since then, that he subsequently said what he said at the time was that at the time they were not sure if we were in fact going to avoid a second Great Depression. They were throwing the kitchen sink at the system. Now, we can all talk about the terms and conditions under which that happened, but the precipice that people were standing on and the country was standing on at the time, make no mistake about it, they were looking at a second Great Depression. So we end up with massive bailouts, unemployment, foreclosure, economic wreckage that actually continues to this day. And among other things that happened, it strangled community banks. Community banks actually ended up paying the price. There are almost 7,000 banks in the United States, just under 7,000. Think about my prior chart. The 6 largest banks in the country now consume, or that at about 2008, it was about 63% asset size, 63% of the GDP of the country. So you've got just under 7,000 other banks. And in fact, if you take the top 12 banks in the United States, I call them the dangerous dozen, you actually get down, if you go to Bank 13, you're only at about $200 billion in assets. And I know $200 billion sounds like a lot of money, but in the banking world, it's very small. Community banks are typically described as somewhere, depending upon who you're talking to, $10 billion in assets or less, or $1 billion in assets or less. They're the exact opposite of the too dangerous to fail banks that we talk about. They're too small to save. There's no systemic devastation if they fail, so policymakers actually care very little about them. They're just, and I put that in quotes, they're just local community impact. But they're often the lifeblood of the community and engines of economic growth. They do far more small and medium-sized business lending in the United States than the top 25 banks. Almost all that lending comes out of so-called community banks. They're also the victim of the unfair benefits of the too dangerous to fail banks on Wall Street that get subsidies and special treatment, which gives them an unfair competitive advantage. Plus, community banks are victims of a Fed policy to keep rates low. Now, Fed policy, we can all argue about it. The two pieces of it, which is the zero interest rate policy and the so-called QE2, which is purchasing treasuries and mortgage-backed securities, are keeping interest rates incredibly low. Well, of course, the way banks make money is called net interest margin. It's the difference between what you borrow money at if you're a bank and what you lend it out at, or what you pay savers and depositors and what you lend it out. In a zero interest rate world, that's the way to kill community banks, because they don't have the other lines of business that can subsidize their revenue and their profits. So to this day, you've got a massive Fed policy to reliquefy and recapitalize the biggest banks, the dangerous dozen, coming at the expense of community banks. So the cost of the too dangerous to fail banking giants is crushing community banks. It's a high and almost never mentioned cost. They get special treatment for the too dangerous to fail banks, and then they cause crash and crisis. And yet, it's still the impact on community banks is still just a small part of the overall cost of the crash and economic crisis, which has been enormous. So what is it? Well, this is a chart that shows you what's called U6, total un- and underemployment. The 1 month peak was in January of 2010, 42.8 million Americans, individual Americans in the United States, were unemployed, underemployed, or discouraged workers. And that continues. Now, it didn't stay that high. It's gone down, but still very high. This is all due to the Wall Street crash. Housing prices actually fell to 2001 levels and haven't recovered all that much. Properties in foreclosure are at 15 plus million and counting. Underwater mortgages, homes where the mortgage is greater than the value of their houses, tens of millions throughout the country to this day. The deficit, people don't think about this. Look at the deficit, where it was going in 2007. Now, I love to hear people talk about, particularly the right wing and others, talk about how Obama's out there spending crazy money and all sorts of stuff. It's like, well, wait a minute. It was all necessitated by not just the dramatic drop in revenue on the revenue side, but the dramatic need to increase spending on the social side that just happened to coincide with the biggest financial crash since 1929, caused by the too dangerous to fail banks on Wall Street. And then most interesting, and nobody talks about this, is the debt as a percentage of GDP projected pre-crisis to be 22.6% in the 10-year window, jumps to 75.3%. A massive jump. Now, if you think about just the debt and the deficit for a minute, everything everybody else cares about, whether if you love the military or education or healthcare or science or technology. There is no money for that, not just because of an austerity ethos, but because the capacity on the fiscal side has been eaten up by the response to mitigate the damage done by the financial crisis. So we've got skyrocketing deficits, which accumulate into long-term debt, which limits the ability of the government to spend money or pay attention or ameliorate problems across the board. Everything you care about, every single thing every American cares about has been impacted by the cost of the financial crisis, which we've estimated in a report that we did will be at least $12.8 trillion over the 10-year window. There have been other studies that put it closer to $40 trillion, which translates to $120,000 for every man, woman, and child in the United States. And that's dollars, not human suffering, destroyed dreams, and economic wreckage. Now, here's something people don't think about either. It's not just it crimps government spending. Charitable and philanthropic activities have been hit hard also. So just the endowments of the top 40 foundations went down over $43 billion, much less money for everything. In addition to that, the contributions to those foundations went down. So it was a double hit, assets down, contributions down, therefore money for services. So you have diminished capacity of government compounded by a diminished capacity of the private sector. This is the report that we actually did. It's available on our website at bettermarkets.com that actually details a lot of these costs and actually puts a human face on them. So what do we do about it? Well, we have to end too big, too interconnected, too complex, too leveraged banking and trading behemoths, which are not banks. And as I say, there's only a dozen or so, and yet they are controlling and dictating policy for the entire country, and it's a Damocles sword over not just the government, but everybody in the country. We also need to revitalize, protect, and promote community banks, the thousands of them that actually support America. How do we do this? We actually know how to do this. Post-Great Depression, we had 70 years of stability and economic growth. Think about this, not a massive financial crash in this country from 1929 to 2008. And people keep saying, well, what do we do? How do we know what to do? Well, wait a minute, we've done it before. We know how to do it. Now, yes, things have changed. It's a globalized world. Banking's different. But the fundamentals of layers of protection of different types is exactly the same. So we have 70 years of stability and economic growth, and what do we get? Deregulation. And it only took them 7 years to crash the global financial system and the economy and almost cause a second Great Depression. I mean, it's Olympic-level, award-winning catastrophe that they inflicted on the country in a very short period of time. So we know what to do, and we know how to do it. The question is, do we have the will? And if there's a will, here's the way. You eliminate the banks, and I'll be very quick because I'm going a little bit longer. You regulate the entire financial system to ensure that new unregulated areas don't emerge. And in such an environment, if you do that, you get the added benefit that community banks will not only survive but prosper along with communities, families, and the businesses they support, as happened for 70 years. So let me leave you on that happy note. Thank you.
Thank you, Dennis. Wallace Turbeville is a senior fellow at DeMoss, who was an investment banker at Goldman Sachs and Company for 12 years, then a visiting scholar at the Roosevelt Institute, where he authored nearly 30 articles concerning financial reform, energy, and the environment. He then joined Better Markets, Inc., where he proposed rules and authored studies to implement the Dodd-Frank Act at the Commodities Futures Trading Commission, Securities and Exchange Commission, Financial Stability Oversight Council, and the Federal Prudential Banking Regulators. He has testified on financial reform issues before the Permanent Subcommittees on Investigations of the United States Senate Committee on Homeland Security and Governmental Affairs and the House Financial Services Committee, and is the author of a report at DeMoss, The Detroit Bankruptcy. Ladies and gentlemen, Wallace Turbeville.
I'd like to thank you, Ian. And I'd like to thank all the fine people at the Hammer Museum, Claudia, and especially Darren Klein, who was helpful to invite me here for this important event. You know, sometimes the very name of an event has a lot of meaning, and that's the case here. This evening we're considering why community banking is a good thing in the context of Wall Street and Main Street, contrasting community banking with the global financial institutions. How do they relate to the needs and aspirations of households, businesses, and governments where the public lives and works. I'd like to reflect with you now on how and why today's financial sector is less likely to serve Main Street than ever before, and why it is not even remotely interested in doing so, and how our robust community banking system could provide many of the answers to this. Now let's start with the condition of Main Street today. The Great Recession has been over for years in terms of GDP growth. Yeah, the GDP is growing, the stock market's growing. But the conditions on Main Street tell us that the GDP by itself and the stock market by itself is a terrible measure of how the well-being of the public is faring. Main Street's the home of the vast majority of Americans, 90% or even 99% of Americans, that form the productive engine for sustaining widely shared growth and well-being around this country. There was once a feedback loop in which a vibrant Main Street fueled growth for our productive capacity, which in turn increased the well-being on Main Street, and this cycle occurred. Well, that feedback loop, that cycle's been broken. One of the hottest books today is a work by a French academic named Thomas Piketty. I think I got that right. He's been referred to as a rock star by my hometown Main Street paper, the New York Times, a rare appellation for an economist. And I got to tell you, I work with a lot of economists at Demos, and our holiday parties are nothing like Mick Jagger's. So this guy is, if he's a rock star, he's really something. Piketty even merited an article on the front page of the style section of the New York Times last week. That's how hot this guy is. He does, by the way, teach at the University of Paris, and there's stylish folks there, so perhaps that's what's going on. The book is entitled Capital in the 21st Century. It should remind you of a book that was written about 125 years ago by Mr. Marx and Mr. Engels. And in a lot of ways, it's almost as profound. It's not Marxist per se, but it does have some observations about them and the internal contradictions of capitalisms. Here's what Paul Krugman, a Nobel laureate, said about it. I'll paraphrase for you. Piketty describes a world in which dynastic fortunes accumulate relentlessly to be passed on from generation to generation and used to dominate politics. These fortunes are used to influence politics so that they preserve this wealth. While simultaneously 90% of the people face stagnating incomes and own virtually nothing. This is what Mr. Piketty has seen as almost the new normal. If the new normal is an economic growth rate that's low, it's like the economic growth rate that was experienced by us all in the centuries before World War I. What he's saying is that wealth disparity will increase as the people that have the money will keep accumulating the money. They get earnings and it gets getting plowed back, and other people won't be able to keep up. And if it goes to these levels, eventually it gets so high that there's nothing left to invest in profitably. But that's so high that you can only imagine that it will create tremendous social and political upheavals that'll make Occupy and the Tea Party look like a day in the park. So that's what he's talking about, and that's what all the folks in the economics professions are talking about right now. In Piketty's world, what he's discovered is that, and listen to this, the past will devour the future. That says it all. This chart from his book, Capital, illustrates his logic. It shows return on capital investment, which is the red line, and you see and the scale goes from he starts in year zero, like literally year zero, and projects out all the way through the end of the 21st century, actually to 2100. So the red line is capital earnings, and the blue line is economic growth, which can be, you can view that just as how much are people making. And the key factor here is that wealth accumulated steadily until 1913. That's where the big dip occurred. Now, in 1913 commenced the period 1914, 2 world wars and the Great Depression, and a tremendous amount of wealth was destroyed and assets were destroyed around the world. So that line drops down, but then picks back up. And what happens is that from 1950 on, you see that the blue line, which are incomes and growth, pops up. And what his theory is that during that period, all of that wealth that got destroyed during the 2 world wars and the Great Depression had to be reconstructed, so great growth occurred. But now, starting in 1980, this is a key date that's going to come up time and time again, he shows that those lines cross over again, and so that now it's more advantageous to just accumulate dynastic wealth to pass on to your children, and that's going to be the way of the future. So what he's suggesting is that the period between 1950 and 1980 was actually an anomaly. Now, here's this is what Professor Piketty has suggested that it's led us to. This is a chart that shows the top 10% of wealthy people in the United States. And what this chart shows, the red line is labor income, and the light blue line is income from capital investment. And the other line is mixed, so we aren't going to consider that. But what it shows is the wealthier you get, as you go from left to right, you go higher and higher in the echelons of people who are wealthy. And what it shows is that it's only till you get to the top 0.1% where actually, as we sit here today, accumulated wealth is a predominant factor. Before that, it's actually income. Now that's where Mr. Piketty's dystopian theory requires some further thought. About half of the wealth of the upper 1% and almost all of the wealth of the next 9% is generated actually by super incomes. Bonuses of bankers, carried interest or profit shares on hedge funds for managers of hedge fund, private equity managers, and corporate executive with bonuses based on stock options and that sort of thing. Maybe even there's a Los Angeles Laker or a Los Angeles Dodger in there or a rock star. But for the most part, it's those people with super incomes. In other words, people are actually getting paid in exchange for something. Well, they're getting paid way too much, but they're getting paid in exchange for something and not just accumulating wealth. So perhaps there's something we can do about this. Now, what the heck has all this got to do with community banking? Well, it turns out it has a lot to do with community banking. This particular chart shows that something else was happening in 1980 that, other than just a shift between growth and wealth. For one thing, Ronald Reagan was elected, and he joined Margaret Thatcher to initiate an era of massive deregulation, the shrinking of government based on the notion that government can't solve the problem, government is the problem. With their help, the beast, and the beast, whether you call it a bull or a bear, but I'm talking about Wall Street, was unshackled and was allowed to run free. It also started a period in which the share of the economy represented by the financial sector doubled to levels only seen prior to the crash of 1929. Coincidence? I don't think so. This chart, prepared by Professor Philippon, another French economist, which, if nothing else, proves that the French produce good economics ideas along with terrific cheese and wine and haute couture and that sort of thing. This chart is very telling. It shows the share of the economy represented by the financial sector. Not its size, but how much of the whole economy the financial sector is, similar to some of the things Dennis was showing. And when it shows in 1980, there was a break upward, and that's continued. Here's the important thing. From the founding of the Republic, and with the one exception right before the 1929 crash, this country has viewed the financial sector as something we tolerate because it makes the real productive economy work better. This shows that the financial sector, because it's grown, its size relative to the rest of the economy has grown so much, It's gone way beyond that purpose. Otherwise, the rest of the economy would grow in lockstep with it. So no longer is the financial sector serving the interests of the economy. It's serving its own interests, and that's not a good thing. Basically, it's become parasitic. Now, when our founders were thinking about what kind of financial sector they wanted, there was Thomas Jefferson and there was Alexander Hamilton. Thomas Jefferson would have said, "Yeah, I told you so." He was always concerned about the problems with too big of a financial sector. But even Alexander Hamilton, who was behind the first Bank of the United States, basically created the whole financial system that the United States had, did it with one thing in mind. It was good for the commerce of the United States and would grow the commerce of the United States. He would be appalled as well. So the financial sector has consumed the rest of the economy, and like a parasite consuming its host. But when I say the financial sector, I don't mean community banks. Now, this chart was put together by the Dallas Fed. It's 1970 and 2010. The red slices of the pie are the top 5 banks, and this is their share of the assets in the whole banking sector. You'll see that the top 5 banks grew from 17% to 52% of the total assets of the entire financial sector. Now, the gray section is very comparable. Those are the 95 banks, which are the next 95 down. So the gray and the orange together are the top 100 banks. Here's the thing. The 12,500 smallest banks in 1970 shrank from 46% to 16%. So the big banks went from 1752. The small banks went from 46 to 15. What does this tell you? It tells you that banking moved from Main Street to Wall Street dramatically over that period of time. Now, how did this happen? This slide shows something else that started in 1980. This slide shows the blue line is the assets that are trading assets in the banking system. The red line is the commercial assets in the banking system, in other words, loans. And what this shows that in 1980, from 1980 on, the trading financial market assets grew tremendously. And so dominated by the big banks, the financial sector became a trading operation, not a lending operation. This was because of a sea change in the basic function that the financial sector provides to society. And here I'm talking about something called capital intermediation. Now, capital intermediation is a term of art, but what it's really talking about is the basic function that banks provide for the economy as a whole. Certainly, they move money around, certainly you get insurance, but capital intermediation is really the basic function. The financial sector provides a pipeline, like the one that's described here. On the left, you see pension funds, mutual funds, other aggregations of money going into a pipeline and eventually getting to the users of capital, like companies and households and business and governments. And the financial sector operates that pipeline, and they take some money out as they go. Now, the whole question is, how much money do they take out, and is it a fair deal for operating that pipeline? Well, what happened was that banking was largely transferred from lending to traders sitting in front of screens. Actually, now they're not traders sitting in front of screens. They're trader robots. I mean, it's literally true. I'm not making this up. In the derivatives market, for instance, over 90% of the transactions that go across exchanges are done without any human being thinking about them. They're all done through supercomputers that are following algorithms to do trading. So it's not really traders sitting in front of screens anymore. This has a lot of consequences. First, the decision to allocate capital, that pipeline, where is capital going to go? That's all based on very short-term values, not long-term values. This is enormously important. The value of investment in infrastructure, small business, and even education can take a long time to actually appear and be realized. It's very hard for the trading markets, since we moved from lending to trading, and that pipeline is now run by computers that operate very quickly. It's very hard for the trading markets, where transactions now turn over at time scales as short as 24 1,000th of a second. 24 1,000th of a second. That's less time than it takes a fruit fly's wings to flap, all right? So how is a system that operates at that level of time scale going to appreciate the value that a bridge or education or even small business can bring to bear? It can't be done. This whole function is now dominated by big, large, supercapitalized, and tremendously profitable financial institutions. The bigness is important. Like a gambler that goes to Las Vegas. If the gambler goes to Vegas, he's got to have a good system, but he's also got to have a good stake to make sure that the system will play out. And that's why the bigness of the banks is so important, and how they have begun to operate like an oligopoly. In other words, they have market power, the real monopolistic kinds of situations where they run the system. Capital for local small business and infrastructure and those kinds of things just is less available. The solution is publicly oriented state and regional banks. And again, we're talking about variations on the bank from North Dakota. And in North Dakota, what they did was state funds were deposited into the North Dakota Bank, and the North Dakota Bank became a bank to other banks. In other words, it didn't go out and compete with other small banks. It made the other small banks throughout the state healthier and better able to function. So the other small banks would actually do transactions, and the Bank of North Dakota would take pieces of those transactions to lever them up so they can do more business. That's a wonderful direction to go in, because it makes the decisions happen closer at home. It avoids this extraction of value, that money falling out of the pipeline into the hands of the big banks. And there's also an opportunity to minimize the influence of big banks on state and local financing, because one of the things that sort of I envision these kinds of banks, what they would do, they would actually be the way, the mechanism where state and local governments raise money in the capital markets. Ian mentioned that I was involved in the Detroit discussion. We had the opportunity to do the research that broke open, basically, the bankruptcy in Detroit. So a lot of the good things that have come out of it sort of came from the DEMOS research that got suggested there. But one of the things that we discovered was just some terrible deals with Wall Street. And I used to be in the municipal bond department at Goldman Sachs. So I'm very aware of how the banks abuse state and local governments. So I think one of the things that we can look for from these kinds of banks is the ability to avoid that and cut that out. So what we're proposing here is an opportunity that will really work to look at community banking with a clear program of wholesale assistance to other banks within states, and to bring finance of state and local governments in line with what they should be doing and what's fair and what's good for them. So I hope that gets some questions from you, and I appreciate it. Thanks very much.
So, Dennis, the statistic of how much the taxpayer got hosed in 2008, whether it's somewhere between 13 and 40 billion trillion. I mean, yes, it's hard to get used to that T word.
Billions, trillions.
Yeah. Sooner or later, it adds up to real money. But the point being that next time we won't have the money, right? That's the real point.
Well,
We
and-
don't. We can't bail them out.
Well, the
When
real problem now is that they're even bigger, so they pose a bigger threat. But there's actually no fiscal or monetary capacity to address the consequences of a crisis now. I mean, heck, we can't even deal with the long-term unemployment crisis that we have, which is invisible but quite serious in this country. But there's no capacity left, having emptied the entire storehouse to respond to the '08 crisis. So that you look at the deficits today, the debt, capacity, the Fed's out of tools and bullets. They're winding down what they're doing. They've got a $4 trillion balance sheet. They used to have a balance sheet that was less than $1 trillion before '08. So their ability to kind of absorb this, so it's true, they can always print money. That's the great thing if you're the Fed. You have an unlimited capacity to print money. On the other hand, the utility and the efficacy of doing that diminishes over time, and alone, it will never respond to another crisis. It's one of the reasons why the Damocles sword has to be addressed, because nobody can withstand the consequences of the next crisis.
One of the things that's interesting there's two graphs tonight, but there's a graph that I've seen a lot, which shows a household income and productivity tracked in parallel up until this key point that you've all pointed out, 1980. Then productivity shoots up and household income makes a slow decline. The chart that you showed on bank profits and relative to household income showed that same divergence in 1980, and the Piketty thing that you showed also shows that same divergence. So did Ronald Reagan re-engineer America? Is that what happened? I mean, who sat down?
It was a hell of a bad year, 1980, yeah.
No, but I'm not a believer of the 5 white men in the back room changing the world, but that's looked like what happened.
Well, one of the things that happened in 1980 was it was your leader, or your former leader. It was Thatcher and Reagan got very concerned that, and Piketty actually treats this. What happened was growth in the United States and the UK, but growth in the United States was leveling off. And what had happened was that growth in Europe and Japan had overtaken us, and they got panicked because they got all scared that all of a sudden they weren't ahead. They sort of missed the point that it was okay that everybody else was growing too, and that set in train a whole series of things. But I think importantly, those things, policy, just made it worse. There was an issue that had a lot to do with technology, had a lot to do with globalization. There were all kinds of issues that were going to cause this cycle where people worked for companies and made money, and it was in the company's interest to pay them money so they could consume and buy product. That's that circle that's broken. So that circle had gotten broken already. And that was that. So they just made it worse, and it was a precipitous.
Right, but they also
1980.
introduced credit at that point to enable people to buy, so that rather than keep abreast of inflation with income and wages.
Yeah, the other thing that happened was Reg Q which was a system where there was a limit on how much interest could be paid for deposits, and they took that off, and all of a sudden debt exploded. But they had to do that because you go all the way back because of the Vietnam War and then the rest of the Great Society. They didn't pay for that, so they had to figure out how to try to rectify the forces in the economy. But I think all of those were important forces that sort of converged around 1980. But I think the bigger questions had much more to do with what was really going on in the economy, and the fact that we sort of missed the point that technology is a good thing, globalization can be a good thing, but we didn't take care of ourselves, which is the real problem.
That's all true, but let's not get lost in personalities. Ronald Reagan was a larger-than-life guy, and Margaret Thatcher was too.
Yeah, that's what I'm saying. They didn't. That wasn't what they did. Didn't. Yeah.
Right. But there's a long-term project that basically started, and it's been well documented by brilliant people, all much smarter than I am, and had a reaction to the defeat of Goldwater, and the right wing, and mainly, capitalist, the kings of capitalism really felt that the country was going to hell in a handbasket, and the market economy was decreasing, and socialism was going to reign in America. So you had massive ideological projects that were funded by large corporations and wealthy individuals starting in the late 60s. And then in the early 70s, you started to see the Heritage Foundation, American Enterprise Foundation, a bunch of so-called think tanks, all funded by massive corporations that built and cultivated an ideological view that got its best in quotes, national expression in Ronald Reagan. But Ronald Reagan alone did not change really anything. There was an ideological framework that was built that government was the problem, not the solution. Regulation was a problem. And the long-term project, which is that we have to unleash the private sector and most importantly the financial sector. And that reached a crescendo actually under Clinton in 1999 and 2000. It began at around the time of Reagan ushering in deregulation, government the problem. But this is a bipartisan long-term project where the economic power in this country actually created ostensibly an intellectual infrastructure around which to implement a political project of what you can call, it's a gross oversimplification, but deregulation. And it's bipartisan. The two biggest deregulatory laws that this country saw post-Great Depression was in 1999 called Graham-Leach-Liley, which took down the Glass-Steagall, one of the Great Depression multiple layers of protection on the separation side. And in 2000, the CFMA, the Commodity Futures Modernization Act, which I'm sure George Orwell's still rolling over in his grave about how politicians have bastardized the American language. It was not modernization. It actually was a law that literally prohibited the regulation of derivatives, 1980. So what happened is we had unregulated, non-transparent derivatives, and I forgot the size of the market in 1980, but last year it was roughly $700 trillion worldwide. So you have a long-term ideological political project that began really in the 60s, caught steam, funded extremely well in the 70s, reached its visible political potential initially in Ronald Reagan, but also ushered in the Senate and the House on the Democratic side, for Republican side mostly, but ultimately the Democratic side, that you must deregulate. And so what we're living with, and frankly, I mean, it's not a mystery. We had the heaviest regulation in the history of the world of the financial sector, and yet we had broad-based prosperity, great growth, and remarkably, Wall Street itself prospered quite well. And then we have 7 years of complete and total deregulation, and in 7 years you have the crash of the global economy. So it's not a mystery what the cause and effect here is. It's a little bit of an oversimplification. But although 1980 is actually a good year to look at it and mark it, because you can see kind of before that ideology captured the national government, and then it propelled it right through the next 20 years where deregulation reached a crescendo.
So, and the Powell memo, of course, is one of the things that's attributed to this change. But was it a conscious effort to end social democracy, which operated roughly from 47 to 77, or just was that the consequence that we've become an oligarchy?
Well, when you have concentrated economic power, which is authorized or enabled to purchase political power, you end up with crony capitalism, and it's called crony capitalism everywhere else in the world. And frankly, America loves to throw that around at other countries. But I do think it was, I mean, even now, I mean, look at what Ryan, the Ryan budget, so-called Ryan budget, right? And it's not just the Tea Party, it's the mainstream of the Republican Party now, which is to have government as small as possible, have regulation as low as possible, and essentially it's back to survival of the fittest.
Well, you see, I keep saying it's not Reagan, it's not the Powell memo. It's the question of why did they win? And they won big. And I think
why did we lose? So
yeah, well, that's the other way to look at it.
So deal with it.
So
I want to know.
So we lost track of something. We conflated the notion that if business does well, that we all do well. So I mentioned earlier the whole question of GDP. and the fact that GDP shows that we're out of the recession, but people are doing horribly. We aren't measuring things properly. And so we can create a situation where businesses grow, the stock market's up. We create a situation where the banks are rich, but they aren't lending and financing the economy as a whole. So what's happening is we've lost track of the fact that the measure of everything should be how well are the people doing, and that's just not we just don't know how to measure that so well anymore. If you go back to the Clinton administration, they lost track of that fact. They were trying to figure out how to create a new paradigm that was all about .com, and I just know that there were people in the Clinton administration that thought that .com was going to bail us out, because I believe they also knew that this income disparity was coming as was a real problem because of the stagnation of middle and lower class folks. So which is why they started, and it was expanded, the whole idea of people being able to borrow against housing, give them a piece of the action. And so what was really happening was they were trying to support consumption, that cycle where people weren't making enough to buy the products to keep business going. They were trying they recognized that cycle was terribly injured, and so they figured that if people could borrow against their houses, they would consume, and the consumption would keep it going until the new paradigm kicked in. So, but it was all about this misconception that what's good for business is good for the USA, makers, takers, job creators, workers. That whole dichotomy, and we just forgot how to measure what's good for people as a whole.
There's another way to look at who won and who lost. You can think you won. I mean, if you look at the polls today, it's pretty fascinating. There's supermajorities that support increasing the minimum wage, supermajorities for heavy regulation of Wall Street. There's supermajorities for all sorts of sensible gun control. You could go down the list. It's quite remarkable how impervious the political system has become to the popular will. Right. So on the one hand, you're right. How did they win, or how did we lose, or I forgot exactly how you phrased the question. But if you look in terms of the American population, most of the issues that almost everybody agrees on, remarkably, almost everybody agrees on. Yeah, it's really remarkable. And if you look at it, you could break it down by age, ethnicity, political affiliation, religious affiliation or not. The majorities, if not supermajorities, are pretty consistent.
But they're terrified of they're terrified of killing the job creators. That's the problem is, yes, that on a policy by policy basis that works, but in a super structural way, people have still not gotten over the fact that if you take the job creators away, there's a problem. So this whole idea of letting business and finance run wild is people are afraid of going back on that, and we're still stuck in an era where that seemed to be right. I mean, it worked for more or less for a long time, from the post-war era up to close to the crisis. But of course, the last years of the crisis, it was all manufactured through this borrowing. But the fact is that seemed to work okay, and it was what everybody was told, and they still believe it.
So just, we want to get to Q&A, but just given that this is such a monolithic and powerful and entrenched system, and these guys at Princeton just did this study that indicated that the financial elite, the oligarchy, if they favor a policy in Washington, it has a 50-50 chance of succeeding. If they're against a policy in Washington, it only has an 18% chance of succeeding. And that's a measure of what you were just talking about. So are there alternatives rather than tilt at windmills and fight this entrenched power? Why not start an alternative universe, local economies? People are starting to think about that in terms of the end of work, changing the whole nature of economies, starting to barter, etc., like that kind of stuff. So is that a possibility?
Well, the problem is that the way the political system controls, kind of the process exemplified by the study, is that the national government as a solution is, to many of these issues is pretty limited, right? So the question is it going to happen elsewhere? So here's an example that you can read in the paper the last 2 days. Essentially, we not only have too big to manage and too big to fail, we have too big to jail. So we've created a double system of justice in the United States where you essentially have immunity if you're a big enough bank to break whatever law you want. Unless you actually happen to do it in New York, and Benjamin Lawsky, who is he's the director of the Financial Services Commission, I think it's called, who's actually taking a pretty hard line, enforcing the feds actually to get more serious. Now, when we say to get more serious, it's pretty marginal in the larger scheme of things, but you're going to see increasingly, and this happens historically, is kind of the cycles between the national government, state and local governments, and then people, and where they get to express themselves with much more clarity is at the state and local level. So I think you're going to see, as you end up with more paralysis or bad policy out of the national government, you're going to see more activist and empowered state and local governments, which is where people will actually get to express themselves in a way that actually there's some connection between the view of people and the expression of the government. The ability to do that at the national level, for a lot of different reasons, but certainly a predominant reason is the campaign finance system, which this Supreme Court is unleashing, like the so-called Lochner Court, for anybody who follows these cases, before the Great Depression, which actually the Supreme Court stopped every sensible social legislation in this country for decades, including minimum wage, not just minimum wage, minimum hours, working conditions, child labor, all of that, regulating all of that was prohibited by the Supreme Court for many years until, frankly, there was a financial crash in the Great Depression. Now, there's some other things going on, I'm oversimplifying, but we're back in the same condition now in many respects, where the national government and the Supreme Court funding the national government and elected officials are detaching the national government from people. So I think what you're going to see is more of it at the state and local level. Whether it takes the form you're talking about, who knows? But I think Benjamin Lawsky in New York is a good example of somebody who's responding to local popular views.
What's likely to be happening here in this country, and I'm going to postulate that it might be best if we have a crash, because what's happening here is we're screwed, blued, and tattooed, and in fact, where we are sort of economically is that I think Mr. Piketty is more or less right, and I think of all people, Larry Summers is more or less right. And we're in a situation where we can't actually get the economy going again in a meaningful way in terms of getting growth going at levels that make sense, because the wealthy have gotten more wealthy. The financial sector is actually an adjunct to all of that, and it's gotten out of control and is aiding and abetting the wealth getting more wealthy. I think it's likely that the whole money and politics issue is going to get worse, not better, because I think I think the super wealthy are going to get more super wealthy. And so while it's a great thing to talk about these banks, these state banks, and to try to get money out the door and have some fiscal stimulus, since we can't really seem to do real fiscal stimulus anymore. In other words, deficit spending the way, build a dam, do what FDR did, build a dam. So all we do now is monetary policy. But think of this. If it's true that the system is totally financialized like we saw on those slides, so that the financial sector is actually using the marketplace and taking money out of the marketplace, if we use monetary policy and push, because there's two things you can do to try to create jobs, right? You can spend money to build a dam and get people working, or you can put liquidity in the system and hope that if there's a lot of cash in the system, people will actually start building factories and building dams and so forth. But when you push the money into the system, and a huge portion of that money is being extracted by the financial sector, why the hell are we baffled by the fact that we don't create jobs? Why are we baffled by that? I think it's pretty obvious to me. Mm-hmm. So unless we have something that's an inflection point, I'm concerned that what's going to happen is these dystopian stories. My God, maybe they're true. So getting money into the system by small business, by infrastructure, by these banks, that would be a very good thing. But I am concerned that it wouldn't be enough to actually make a difference.
It seems to me that the thing that's missing in this whole system, the money is with the government, well, state and local governments, let's say. So they have huge deposits, huge capital base, and the only banks that are large enough to hold that capital and deposit base are the big Wall Street banks.
Why is that?
Because they require collateralization, and only the Wall Street banks have all those. They have all that stuff sitting on their books, which is federal securities, mortgage-backed securities.
Yeah, but that's a rule that can be changed, of course. You can have your own bank. Yeah.
But if you could form your own state-owned bank, put all those assets in it, leverage it, and do like the Bank of North Dakota does, and partner with the local banks. I mean, it seems to me that the local banks themselves are not large enough to fund the whole system without some sort of central bank-like entity that can get capitalization and get liquidity out to the local banks.
It's Bank of the United States. It's the way the Bank of the United States was created in the first place. Right. Alexander Hamilton's.
Agreed. But I did have a question for you. Sorry, you'd mentioned that in Detroit, or that in general, that these municipalities had gotten into these really bad bets, and that you worked in that department.
Yeah, I did.
So it seems to me that they could be sued for I assume you mean interest rate swaps. It seems to me that they could be sued for that the swap itself is a fraudulent device.
Well, that's what we did in Detroit. That was the argument in Detroit. There was a big deal, big bond deal, borrowing deal, and the interest rate swap was attached to it. The bond deal was where the real true fraud was, but more conventional fraud, let's put it that way. But what we were able to argue was that the swaps were per se in the area of fraud because they were so complex that nobody could have understood them, especially not the municipalities. Yeah. So Detroit being being a place where if you can push hard enough, they'll do almost anything to get some cash back because they're so broke. That we were able to get the emergency manager, who was basically a dictator appointed by a Republican governor. But we were able to embarrass him enough that he actually, actually what happened was the judge forced the emergency manager to put the screws to the banks, which is what happened eventually. But you're right. It's look, the derivative instruments like that, and they are per se more complex than anyone can understand, even the simplest of them, and there are very few simple ones that actually happen in these markets. So, you're right.
Right now, there's this whole issue about LIBOR being rigged, but then the Goldman Sachs, which negotiated a lot of these swaps, was not one of the rigging banks. So then the argument is, well, they didn't participate in the fraud, so you can't sue on the basis of that fraud. But it seems to me that the whole device was fraudulent, and so you actually prevailed in court on that argument.
The big deal, the big bond deal, is going to court they're going to try to get that voided completely, $1.4 billion. The swap itself, the judge more or less took care of. They were trying to settle it for something like $300 million, and it got down to $85 million, and the judge said that's good enough, that's close enough, we'll let you settle it. But that's the way we got it that way.
Could I just comment just very briefly on what you said initially, which is bank size? You know, there's this myth that if we do not have these dangerous dozen gigantic global banks with trillion-dollar balance sheets, then my gosh, the other banks just can't service the economy and can't do what they have to do, either for state and local governments or for our economy. And it's just bunk, because first of all, if you've got a $200 billion or $250 billion in assets, you're a big darn bank who can do anything you want. But you're not so big that if you failed, you would bring down the financial system. And if you go back and you look at the size of the balance sheets of these banks, which I had in one of my charts, and you go back to, let's say, 2002, was the United States national economy paralyzed because the biggest banks at the time were half the size in 2002 that they were in 2008? No. In fact, J.P. Morgan Chase, which now has about a $2.4 trillion balance sheet, had a balance sheet at the beginning of 2008 of around 1.6, 1.5 trillion. In fact, I even confronted one of their officers once and said, because they now say we must be this big in order to service our big clients. Well, were you a total failure in 2008? I mean, were your clients going, you guys stink, you're too small, you must get... No. It's absurd. It's just myth. It's a bunch of baloney. But that's because the biggest banks accrue huge benefits from their size, the most important one of which is they don't fail. Unlike every other company, firm, commercial activity in this country, if you fail, you go bankrupt and you pay the consequences of that. The only industry, and there's only a teeny-weeny part of the industry, it literally is about a dozen of the biggest banks. Other than them, the rest of the country operates according to the rules of capitalism. One of the things I always find amusing is they say that the center of capitalism, free market. Actually, Wall Street's the only place in the country where socialism is alive and well. Well, that's true. The military's got a case, except most of the defense companies would actually fail because they wouldn't take down the economy. But the banks, not only do they get subsidies, not only do they get an unlevel playing field, not only do they get to operate an oligopoly, not only are the laws not enforced against them, but they don't. If they were to fail, they don't fail. They fall into the comforting arms of the American taxpayer. I don't know what socialism is defined as, but that comes close. So Jamie Dimon is the best example of socialism in the United States today, along with J.P. Morgan Chase and Goldman Sachs. And you want to talk about takers, makers, or who's on the dole? It's the big banks. So you don't have to. We don't need them for economic reasons. We don't need them for social purpose reasons. We have them for aberrational reasons in this current moment in time that have to do with both campaign finance and deregulation, among other things. But there's no reason why our state and local governments and our economy at every level could not be more than adequately serviced by banks that are not too big to fail.
The Fed and other regulators keep conflating something that's problematic. First of all, I got to tell you a story. I'm dying to tell you a story. When I went to work at Goldman Sachs in 1986. I am old. So and worked there in '97. We used to do charts where we'd go to potential clients and say, here's how strong we are. This is like straight out of Dr. Evil. Dr. Evil. We would say, we have $1 billion of excess net capital, $1 billion. And hope and think everybody's going to get sweaty because we were so big. We keep conflating something, and the regulators do it, and implicitly your comment does it, which is that if a bank or financial institution is very profitable, that's a good thing. It makes it more stable and more healthy. Well, in fact, after a certain level of boring banking, the more profit that you make, you only make the profit by taking on risk. So the fact of the matter is that when the Fed says, oh, the banks are very profitable, that could be a very bad thing. And government doesn't get it, nobody seems to get it, but it's true. Big isn't necessarily safe.
It's been reported that the marijuana industry cannot do traditional banking because of federal rules. And I'm wondering if there is an opportunity here to create a new, very green infrastructure bank, specifically in the state of Colorado, maybe Washington State, maybe here in California, of the profits from these dispensaries. They get a secure way to bank, and while creating a fund for literally green infrastructure investments. And culturally, I think that would be very appropriate too. And I'm wondering if that has been broached.
Well, do you think the tellers would be stoned? Because maybe they give you too much money in the transaction. I'm all for that.
Well, and people might care less about the crashes, I guess, right? I mean, it's like, It's all upside.
This gentleman on the end here, yeah.
Does the Federal Reserve Bank have a public positive role in this picture? And if so, why? And if not, why?
In the picture. You mean what can they do? Yeah. The Federal Reserve has several functions, right? One is monetary policy and trying to manage inflation and unemployment and growth, and they've been trying to do that. And the Federal Reserve has a big role in reducing the size of their balance sheet over the next little while as growth does come back, and getting that right. So that's a big role to play. I feel strongly about the whole fact that monetary policy has a real problem as long as we're financialized as well as we are. The other thing that the Fed does, broadly speaking, is that it monitors the banks. And one of the problems is that since the Fed monitors the banks, it's all about looking at what banks do and measure what's going on, rather than regulating them and telling them they can't do certain things. So the Fed actually institutionally is a problem in that sense, because they have this desire to monitor the banks. You hear a lot of folks, I don't know what Dennis's views on this are, but you hear a lot of folks talking a lot about we just need to put more capital into banks. I'm not one of those folks. I mean, capital in banks is fine, okay? Maybe good, maybe even be bad. But in the sense that you might have a situation where you allow them to take so much risk that the crash is bigger even than if they were actually had a little less capital and were smaller. I'm a believer you got to keep the banks from doing really risky things, and rather than worrying so much about monitoring them and making their capital bigger. And the Fed is sort of an impediment when it comes to that, because their job is to monitor the banks. They think they can control things by doing that, so therefore they don't really like the idea of other agencies telling the banks that they can't do certain things. So in that sense, they're problematic. So I think the Fed is sort of less useful and maybe more problematic than they've been in a while.
The lady that I shortchanged in the beginning, I feel very guilty about it.
I just wanted to say before we start talking about the crash that there is a solution. Ellen and I and a group of people are working to start a city-owned bank. We feel that the administration right now, the mayor and the city council, is progressive enough. I've spoken to people in the administration. They're very interested in this. And like you said, on a local level, it's a lot easier because of lack of corruption. So here's the thing. A group of 15 organizations and unions just released a report. They're a coalition called Fix LA, and they showed how Los Angeles spends more on Wall Street than on city streets. They spend $204 million on fees. And the deputy mayor of budget told me that they spend $600 million on interest payments. So if we could if we had a city bank, we would be putting all that money into the city, which could in turn, there would be less money going to Wall Street, so more money to fund other city services, libraries, street paving, and we could finance public infrastructure projects, and the money that we would pay, the interest would go back into the city bank. So I just wanted to announce that because we're working on it. We're going to need a lot of help. Obviously, I also fight fracking. Big oil is a huge lobby, but big finance is even worse. And there's going to be a lot of pushback against this. We're going to need a lot of people power to get this passed. So if anybody has any interest in working on this, if you know any organizations that we should be speaking to, neighborhood councils, community organizations, please see me afterwards. Thank you.
The unions actually asked me to be one of the validators on that report. So I get calls from time to time and from reporters, who asked about that report, which was a good one. But I think that you're spot on. Not every number is perfect in the report, in my view, but you're spot on that the level of corruption, like bags of money and other forms of corruption associated with local finance, can burden these cities terribly over a long period of time. And I think you're right. It's some kind of a bank. The further you can get the financing activity and what you do with Wall Street away from elected officials that have to finance campaigns, the better. And I think that's a real salutary result.
Right. So this will have to be the last, the gentleman in front of you.
My question is quite simple. How do you expect to monitor these banks? And the reason for the question is we used to own a community bank. My family did. And as a teenager, I watched the monitors come in, and it was a joke. The people who got the money were the people who did business with the family corporation. And that's going to trickle down all over the place. And you've seen what's happened in Bangladesh in the Indian Protocol with these community banks. Initially, extremely successful. Then an explosion of debt. And now you're going to have 100,000 banks. There's no way you're going to be able to monitor this. You're putting a Band-Aid on an elephant's butt, and unless you go back to re-gutting the Banking Act of '33, I think you're kidding yourself. The question becomes, how are you going to monitor these banks?
Well, clearly, one of the decisions when you start talking about these banks doing things like infrastructure projects, like small business loans, like education, by all these things, you quickly run into the issue of who decides what to do, who gets the money, right? So you're right. It's a very deep concern about whether crony capitalism of a different kind crops up and becomes problematic, and it gets further, because it's further down the food chain, it's sort of more hidden. So I think you're sort of damned if you do, damned if you don't. But the way I've described it before, you really need sort of the alien nests and the untouchables running each one of these banks, and very strict controls and very clear ways to decide what you do and what you don't do. Otherwise, that is the risk. On the other hand, nothing's getting done now. So there is that, but you're right, there is a risk.
Well, you have to be a little bit careful too when you talk about regulators, because the part of it can be some people think it's a problem, some people think it's ideal, but there's a whole bunch of banking regulators. It's not just the Fed. It's the Fed, it's the OCC, it's the FDIC. And the FDIC, I think, is viewed generally as having done a relatively good job of monitoring banks and dealing with bank failures. Now, there's disagreement over that. I'm not trying to suggest that that's the only view. But the problem gets back to the issue with the Fed. I mean, the problem with the Fed is is the product of a political compromise and is a hybrid, which reflects one of the most fundamental disagreements the country has had about who handles finance in the public versus private role. And the Fed was originally, actually in 1913, created basically as a servant of the banks, rewritten and reorganized after the Great Depression to have more of a public dimension to it to try and temper the banks. But the Fed too often sees the banks, when I say banks, they really are thinking about the biggest banks in the country, and they see them as clients to be coddled and nurtured. And as Wally referred to, they're always bragging about, oh, profits are up, our banks are great. Well, if your profits are up because you're reaching for yield and most of your profits from derivatives instead of funding commercial activities, maybe it's not so good to have good high profits. But when you're the Fed, you've got this hybrid structure that's much of it is controlled actually by the banks, the biggest banks in the country, with some public aspect to it because the president gets to nominate and the Senate gets to confirm the federal board, not all of them because there's 12 of them, but the regional members of the Fed actually are picked by the bankers from their regions. The most important, powerful region is New York, controlled by Wall Street. On the other hand, you've got banking regulators who failed abysmally. I mean, the OTS, the Office of Thrift Supervision, was eliminated in Dodd-Frank because of its gross failures to monitor in any way, never mind police, the banks under its jurisdiction. And so you end up with this system that is a cacophony of voices and a bunch of different supervisors, regulators, and monitors who are often competing with each other for jurisdiction and for, kind of bureaucratic prizes and preening. So you have to, it's a real problem. On the other hand, we need a financial system that actually works and supports the real economy and helps growth and jobs and our standard of living. So the question is, given that we need it, and given that there's this inherent proclivity within that system to reach for yield and speculate and engage in non-productive activity that's incredibly lucrative for the people in the system, incredibly bad for the people not in the system, the rest of the country, how do you strike the balance, and where do you strike the balance? One of the things we do at Better Markets was created in 2010 to essentially represent the public interest in the financial markets and financial reform. And some people say, well, why do you bother doing that? Because you're never going to beat Wall Street. You're never going to be as big or bad or as economically funded. On the other hand, you can't just leave the field and say, well, to heck with it. Let's have another crash. That'd be great because then we could really do some reforms. The problem is on the way to that, you have a second Great Depression, you have 25 to 30% unemployment. The cost of the last crash, call it 13 trillion to 40 trillion. That'll be a drop in the bucket compared to the next one. And what's most worse, and Ian referred to this, is our ability to try and ameliorate, as imperfectly as it was, or mitigate some of the worst parts of that from a social point of view. The ability of the federal government to do that next time is incredibly limited. Incredibly limited. I mean, when you look at the debt to GDP at being in the 70% range, there's very little capacity to address that. So you've got to make a decision. There's no perfect solution for the Fed or for bank monitors or bank supervisors. So what you've got to try and do is push back against, as effectively as you can, the incredible pressure coming the other way. Now, a city bank, if done right, constructed right, politically insulated so that the kind of the corruption doesn't come home, and other types of alternative funding. Move Your Money was a campaign with taking people who actually move their money from the too big to fail banks to local and community banks, which can be $10 billion banks, depending upon how you want to define community, which do a whole lot of important things, not necessarily the $10 billion level, but the billion and under level. I mean, when you look at the lifeblood of the communities in this country, community banks are at the corner of it. So supporting them, creating new alternatives, supporting the ones that actually work for the real economy, and trying to put a brake on the bad ones that have the Damocles sword over our neck is something we all should try and do, and fight the pessimism or the urge to walk off the field and not engage in the fight, because the consequences of doing that are, pretty grave and, frankly, unworthy of a democracy. We've got to figure out how to make it work within the democracy that we have. And that's, what we try and do at Better Markets, and that's what you're trying to do in LA with the bank, for the city bank. And that's what we just have to keep doing. But you have to keep in mind the consequences of not getting it right are really, really draconian. I'll tell you, I was in a room in January of 2009, and people think the crash stopped when Lehman crashed in September of 2008. But in 2009, I was in a room with the chairman of the Federal Reserve Board, all the senior leadership, economic leadership of the United States, the senior political leadership, and they were talking about what they were doing to try and arrest the crisis at the time. And the comment was made by one of the senior economic leaders of the country that not only was everything still going down, it was going down at a rate faster than at any time during the Great Depression. I mean, think about that. So somebody in the room said, but we're going to avoid a second Great Depression. And the answer was, well, we hope so. So the good news is we did. The bad news is we put ourselves in a position where those decisions and choices had to be made. The trick is to try and figure out how we can go back to a period in time where we had 70 years roughly, of stability, prosperity, and widespread growth, where the banks played the right role, regulators more or less played the right role, and government more or less played the right role. So we know how to do it, we just need to get back to it.
Well, I thank both of you gentlemen for joining us here tonight.